Welcome to the Cirrus Foundation series. In this episode, we focus on building market risk appetite model. Hi, I'm Satya Pradhuman of Cirrus Research, and we thought about this topic for a while now, and I thought it was an interesting way to present material of various models and indicators that we've surfaced over the years. And to some degree, there are some really neat ideas out there that sort of like you use it when you really needed it. And we thought this was a great way to share our research library. So in this episode, our senior analyst, Georgiana Fung, walks through how we construct a risk measure. There's all this conversation right now in the markets about risk taking and risk appetites. And this is a reading that we've had for many, many years. And we thought it was a great way to maybe share with you what how we can frame such an indicator. I hope you enjoy it. Thank you.
Hi, this is Georgiana Fung from Cirrus Research. In this portion of the Foundation series on building a risk appetite model, I will go over how we look at the model itself, the building blocks of it, and implications for equities. Here you're looking at the Serous risk score, which is our model for risk appetites. It's a cross-market measure of investor willingness to assume risk. And there are two primary zones that you should pay attention to here. One's the speculative zone, which is above the 1 standard deviation line. And the other one is the defensive zone, which is below the negative 1 standard deviation line. Now, this indicator can range anywhere from between negative 40 to positive 40. And we find that there's a mean reverting tendency in this indicator. So in one example, you can see that it goes really above the 1 standard deviation line at the extreme here in the speculative zone, but it always comes back down towards the mean. On the reverse, if you see a very extreme risk aversion here, you can always see it popping back up as well. So that's a mean reverting tendency of the indicator. We also find this a useful contraindicator. We'll go over this concept a little bit when we go over the implications of the indicator itself. So currently right now, we're at the lower end, which is in the defensive zone. The reading is in negative 13. So it's fairly defensive, but not as defensive as in 2008 during the financial crisis. Now, if you look outside US, we've also replicated this model for a lot of other countries, key markets as we call it. Here you look at the US compared to Canada and Europe. Now you see that they trend together pretty well in the past and also in the current period as well. So this is available globally. Now, having seen what risk appetites are right now, you must be asking yourself, how do we build this indicator? Well, there's 7 components that make up the index. Some of them are intra-equity and some of them are cross-market variables. The 7 variables are divided into a speculative tail and also a defensive tail as well. Each time we see a speculative tail outperforming a defensive one, we give a score of 1. This is why we call it the CRX, the Cirrus risk score, because it is a score after all. So as you have seen in the chart that we showed you throughout time, it could be very erratic. So with this, we do smooth out into an average so that we could make it a little bit more useful. Now, if you look at these 7 factors or 7 components, we look at various items that are pretty common, pretty clear cut. First, we look at market cap. So if small stocks are outperforming larger ones, we give it a score of 1. We also look at beta. If the riskier stocks, meaning the high beta stocks, are outperforming the lower beta one, which is the more defensive tail, then we give it another score of 1. Same for income. If you don't produce any income or you're not profitable over past 4 quarters, then you are in the speculative bin. On the reverse, if you're profitable, then you are considered more defensive. Dividends, non-dividend paying stocks are riskier, they're growth typically, so we put in the speculative bin, and so on and so forth. Some of the cross-market variables that we use is the LIBOR Treasury spread. This tells us if there are credit risks in the market. So naturally, if spreads are quite wide, then that would be speculative. If spreads are narrow, then that would be defensive. Another cross-market variable that we look at is we look outside the US. Emerging markets are outperforming the S&P, then we put in the speculative zone. And then one last factor is earning stability. So if a stock or a company is more stable in earnings or has less variability, then the more stable companies would be naturally defensive. The less stable would be speculative. So in the perfect world, we will have all these factors line up, but other times it won't. So, you know, if all 7 factors are speculative, you will get 100%, but which is not currently the case right now. You have some that are speculative and some that are not. So there's a good mix in here, but overall, we are looking at a pretty risk-averse environment in the equity market. So moving on to implications, when the market is very risk averse, which is the case right now, that's when we see a stronger market to come. On the flip side, when you see that risk taking is very high, we tend to see weaker markets to follow. So you'll see this illustrated in this chart here. Where we are currently is the bottoming of risk appetites, which is in this area. So as we move into this area, you'll see stronger returns for, let's say, the small cap stocks at around 18–19%. Whereas if the CRX is in a very speculative state, so if investors are taking more risk in general, you'll see the market become a lot weaker. So generating about a 13% return. Same thing for large caps. So you can pretty much see that, you know, as the CRX bottoms, the expected return for a market over the next 12 months would be a lot stronger. And we also look at the subsequent performance by factor as well. So if you concentrate on the risk averse area, which is where we are right now, you see that value tends to have an edge. Whereas when risk taking was very high, you see much lower return. So it goes from around 33% to about 23%. On the flip side, when you see that risk taking is very high, you see that price momentum actually falls behind. And this compared to around 24% when the market is much more risk averse. So just to go over what we had covered, CRX is our overall measure of risk tolerance of the market. It is a contra-indicator for identifying market timing opportunities, and it has a mean reverting tendency. So what this tells us right now is that we're in a very defensive state. So expected market return could improve going forward. And how do we build this? We had used 7 intra-equity and cross-market variables, and we stratified them by speculative and defensive bins. And out comes a score, which helps us to track the risk appetite of the market. And in terms of implications, what we find is that expected return improves following periods of risk aversion, which is currently the case right now. And we also see that value tends to have an edge. So this pretty much summarizes what we had covered for how we had built the indicator for risk appetite. If you need more information or more details, please let us know. Feel free to contact us at Cirrus Research. Thank you.